Okay, we'll get rolling here. Thanks for joining today. My name is Rob Anton, President and Partner with Next Edge Capital. Joining us today is Anthony Scilipoti, President, CEO, and Founder of Veritas Investment Research. The focus of today was going to begin with a quick intro into the Veritas Next Edge Premium Yield Fund, an overview on the product. Then I was going to pass it over to Anthony, who is going to focus on various different things, discussing kind of his macro themes and ideas, as well as various sector equity picks, as well as maybe a few things to stay away from. I thought I'd begin just by starting off on why I think fundamental investing makes sense. I've been in the financial business for over 30 years. And for much of my first 10 to 15 years, I think much of money management was done either advisors picking stocks themselves or farming it out to various different mutual fund managers. And for the last 15 plus years, obviously, we've seen a huge shift into, ETFs, a lot of that being passive ETFs. And much of what I'm reading today, tells me that, where we stand currently is over 50% of equity ownership now in the US is actually from passive ETFs, whereby from a fundamental basis, these are investors that don't really care about price to earnings ratios or any type of fundamental metrics such as book value, free cash flow, or anything that I've been taught over the last 30 years actually makes sense. And that equity ownership of those types of investors is growing at about 4 to 6% currently, and I think poses a potential problem going forward, and I think is a key reason why I think some people should actually keep a balance between maybe index investing as well as some fundamental ideas that we're going to talk about today. With regard to the Veritas Next Edge Premium Yield Fund, the fund is constructed, and focused on, it's an equity income fund with a bias towards yield and capital preservation. The equities within the portfolio are derived from the Veritas research, and Anthony will go into that story, but Veritas has been, around for over 20 years as a research company, creating, value-added ideas for the past few decades. I'll let Anthony kind of get into that story a little bit. In addition to that, the focus will be on capital appreciation, but as well as yield. The yield will be comprised from two different components, dividends, which, currently in the portfolio are around 2.7% yield from dividends. And then typically on a monthly basis via, covered option writing, we're generating about 25 to 35 basis points extra yield in the portfolio through this option writing. I'll get into that in a little bit further detail. So that's kind of the crux of this portfolio. With regards to the equity selection within the portfolio, typically the portfolio would look like anywhere between 30 to say 40, 45 names. Currently, there's 28 equity positions within the portfolio. The equity positions within the portfolio are derived from the Veritas buy list, which for the past 24 years, they've had a buy and a sell list, that they've tracked all the calls that they've made. And, when the core of the, equity component of the portfolio, which, our fund has only been around for just under 2 years, but Veritas has been making these calls and tracking their buy list and sell list for, 24 years now, and have shown significant value at it, whereby their Veritas buys have outperformed the TSX index by about 3.5%. And the Veritas sells have been underperforming the TSX index by 4.5%. So value added on both sides of the equation. And that comprises the core of the equity component of this portfolio. In addition to the equity component of this portfolio, we are generating some extra income in the portfolio through an option overlay strategy. We are writing options on up to 30% of the portfolio, so not 100%, but up to 30% of the portfolio. The in-house Next Edge team that is managing the option strategy both have approximately 30 years of experience in option overlay strategies in a professional manner. The option strategy will be very active and opportunistic. I know that there's a number of options out there for you to choose from with regards to income strategies which utilize options. Most of them I see are very passive and kind of set it and forget it type strategies. This is going to be, quite active and opportunistic, whereby, for an example, not a week or two goes by whereby we might be writing options whereby within a week the stock might have fallen, come down significantly from where we wrote the position at, and captured maybe 80-85% of the premium in the first week of writing that option. We may cover that option and look for an opportune time to rewrite, because we've captured most of that premium as opposed to holding it for another 3 weeks till maturity. We're focused on shorter dated options, such as typically out 1 month, whereby options have the highest decay rate, or what's called theta. Just means you're capturing more premium by focusing on shorter dated options. And these options are written out of the money. In general, 1 standard deviation out of the money, which really just means that, one, you're allowing, these positions within the portfolio room to breathe or capital appreciate, which I think is quite key, because we really don't want to detract from that long-term Veritas, equity track record. And number 2 is, as opposed to many other option strategies out there that I see, many competitors would tend to write at either very close to the money or not differentiating how far out of the money they're writing of one position versus another. And what that really means is I see some option strategies whereby they're just blanket writing, say 5% of the money, and not differentiating between maybe one equity position that has an implied volatility of 50 versus another that has an implied volatility of 15. And, by writing at 5% of the money, obviously the one with a 50% implied volatility is the highest chance of getting called out and capping its upside, which is something we don't want to do. So what we're doing in this portfolio is we're writing, on average 1 standard deviation out of the money on each position, which means that something with a standard deviation of 50 is going to be written at far further out of the money than one with a standard deviation of 15. So it makes much more rational and fundamental sense, and allows the portfolio to capital appreciate. One thing that I mentioned, this is kind of a snapshot of the portfolio as at the end of last month. By partnering with Veritas Investment Research, an independent firm, their market calls, such as their buys and sells, can look vastly different than what the street's buys and sells look like. And that translates into our portfolio. So when you look at what our portfolio snapshot looks like from a sector basis versus the TSX index, you can kind of see some glaring differences. Halfway down, you see the financials. We have, a 7.5% weight to financials with no bank exposure, whereby the TSX index is currently at over 30%. A few other glaring differences. We have an 11.5% weight to consumer discretionary, whereas the index is around 3.5%. We have a 10.5% or almost 11% exposure to communication services. The index is just over 3%. And, even on materials, where we're almost 17% exposure versus 11.9 for the index. So this is not a fund that looks much similar to other Canadian equity funds, nor the TSX index as a whole. With regards to returns, the fund has been around for just under 2 years. It's till the end of April, it's compounded at 8.6%, pays out a 5% distribution on a monthly basis, typically generates in and around that 6% through a combination of dividends and yield generated from the option strategy. Thus far in May, we're having a pretty good month. So, we're likely annualizing at over 10% since we launched this fund. Lastly, the fund set up as just a prospectus mutual fund, available for purchase daily, 80 beat management fee on the F class, $5,000 minimum. And as I mentioned before, pays out a distribution monthly. With that, I'll pass it over to you, Anthony. And, if anyone has questions, please feel free to type them in to the Q&A function, and we'll likely answer most of them at the end. But if relevant, we maybe can answer a few along the way. Over to you, Anthony.
Thanks very much.
I'm not
Rob.
sure if I just wait. I can One sec here. Share clipboard. There we go. I think you got control now, Ethan.
Oh, and I do. Very good.
Technology.
Yeah, no, it's great. Thanks, Rob. And I want to thank all those who've taken the time out of their day to join us today and listen to our story. I'm pretty excited to be here. I'm excited to have had partnered with a longtime friend as well here in Rob Anton. We started our business. It grew out of a forensic accounting practice, and I remember in 1999 and 2000 when we were writing, even before the company was called Veritas, and people thought we were crazy, talking about things like TLC, the Laser Center, and Royal Group Technologies. They had bad governance and bad accounting, and CallNet, and then of course we said all kinds of things about Nortel and warned about that. And really, what's been the cornerstone to our work is you win by not losing. And if you've done your work and that work shows that the underlying fundamentals are not being reflected in the company's stock price, it's just a matter of time and patience for that to play out. And we've proven that over 25 years. And conversely, if a underlying fundamentals show weakness, especially deception among management, a sneaky, cheeky accounting. It's typically, these are all signs that we saw in many of the names here that I've listed, and there's so many more that we've warned on, that ended up costing investors a lot of money. And, let's see if I can get this to work. It's not, oh, there we go. So sorry, it's moving too fast. We'll get this correct as we move along here. This is our research team, and I'm really excited to say that they've been with us for an extended period of time. Okay, we're a 100% employee-owned firm. You can see here we've had members of our team here as long as 18 years, and of course we have our core of new recruits that are learning as well, that are associates, soon to be also analysts, and we train all our own analysts to become we start them out in our process to become accountants as well, because we're a CPA training house. We do a number of events as part of our services on the research side, and also for our large asset management supporters, where we have best ideas calls. We do analyst presentations, focus on training, because we strongly believe that a better investor is more knowledgeable, and we train them to understand our process, so they can also pick their own stocks and become comfortable with the portfolios that we also manage. This is the core that really drove us to launch our asset management arm in 2018, was putting together a list of our best buy ideas, which we call our V list. And this shows the performance really over just over now 20, over 20 years that we ran this, because October 2004 we launched. And you can see that over time we've outperformed the index, and most importantly, protect on the downside. And as Rob mentioned, look much different than the index. Here you see the exposure to financials over time in around 50-60%, and on our V list it's been significantly lower, anywhere between 30 or 45 and 30%. So you do it, and we don't care what the index looks like. So we have three total funds. We launched our Canadian equity product, which is all our Canadian buy ideas packaged into a portfolio. Similar, looks nothing like the index, as Rob mentioned. And most importantly, true to our form, this is a long only fund. You can see that when the market's had its long drawdowns, sharp drawdowns since 2018, we've outperformed, in the sense that we go down significantly less than when the market drags down. We launched a long short fund, which is a liquid alt called our absolute return fund. This fund takes advantage of our sell ideas, so we can actually not own banks, we can short them, we could be short some materials. I'm going to talk about how we're concerned about copper, so we're short some copper names. We think this run up is way overdone. We're short some consumer names, things like Canadian Tire. We think discretionary purchases are really going to get hurt in today's environment. So we'd be short some of those. And so that puts together a portfolio where, as you can see in Q1 of 2020, when the market had significant drawdowns, we were actually positive. So not just being able to sort of outperform on the downturn, also join in some of the upside. And in some instances, when the market's down, we can actually be positive. And of course, the next edge product, which I won't talk to anymore, is Rob's done a fantastic job explaining how we do that. So that's our funds, a little bit of background on Veritas. I want to spend the next 45 or so minutes, and I want to talk to you about 20,000 feet, what we see in the marketplace, and with a view to you thinking about how your client portfolios are positioned. You don't need to have myself or Rob tell you that we're living in complicated times. There's all kinds of macro factors as well as factors, geopolitical, wars, protests happening all over the world. And yet, when you look at what's, plus we just came out of a pandemic, and look at this chart. This is 5 years of our key stock indices, the TSX 60 and the S&P 500. And who would have known there's a pandemic that took place? We've had double-digit returns in most of these years, okay? And sure, we had a bit of a drawdown in 2022, but even 2024 looks fantastic coming out of this. And you can't pick up a piece of news that's not telling you that there's going to be a recession or that there's something to be worried about. I tell you, one of the key things, I do a number of client events talking to advisor clients, and one of the key messages I tell them is stop reading the newspaper, because newspapers will drive you crazy, just scare you, and scaring sells. So when you think about your client portfolios, how are they positioned? Do they assume a soft landing or a hard landing? And how are you positioned relative Canadian to US? And clearly buying Canadian indices anytime since the financial crisis has been a stupid idea. US has far outperformed the Canadian index, and that's fine. Those are facts. But the key thing I'm here to challenge you to think about is, remember the time prior to that, in the decade prior to the financial crisis, Canada far outperformed the US. And I wonder, as we go forward here in the next decade, whether it's going to really look like the last decade. And we think it's not, for a number of reasons. And we've had a number of different webinars on that. But I'm going to touch on why I think it might be some time to start thinking again about Canada. So this chart here shows you the earnings yield compared to the bond yields. I'm comparing the S&P 500 earnings yield to the 10-year bond in the US. And what you can see is the bond yield in blue. The yield on the 10-year bond is higher. I said that right, higher than the yield on the S&P 500. And typically that's not the way things work. When you buy equities, you should get paid more because you're taking on higher risk. In Canada, we understand that pretty clearly. You can see that the yield on the TSX 60, that's in red, is far higher, or somewhat higher than the yield on our 10-year bond. If I put those two graphs together and I just show the comparative spread, in Canada always in red, blue in the US, you can see that in US it's negative, in Canada it's positive, nearly 2.6%. And so this is unusual if you go back in time. So does this mean that maybe it's time to start thinking about allocating some more capital to Canada? Well, clearly there's a reason why the yield on the US earnings is so low. And maybe it has something to do with earnings growth. And frankly, if we look at the earnings projections for the S&P 500 over the next 2 years, they're projecting a cumulative average growth rate of 16% over the next 2 years. Meantime, the S&P TSX 60 is only showing a projected consensus earnings growth rate of only 8%. So maybe it makes sense that the yield should be significantly lower in the US than it is in Canada. The question is that sustainable, and why is that the case? And here's where, we have nothing else to do, so we spend time looking at details and digging through the numbers. So I like to break apart the S&P 500 into two buckets. We got the Magnificent Seven, and I don't know if it's seven anymore. I don't know if you want to include Tesla in there. So maybe it's only six, but for all intents and purposes, let's leave it at seven. And then we have the sloppy 493. And you can see going back to 2019 that the Magnificent Seven in Burgundy has far outperformed the performance of the sloppy 493. And so when you look forward, it's going to be even more interesting because the expectations in 2024 are for that Magnificent Seven to grow its earnings at 39% and for the sloppy 493 to grow at only 5%. And today is an interesting time to have this call because in just a couple of hours, we'll probably know how this 39% is going to look like because Nvidia is going to be reporting their results. I don't have any special insight, but I have seen these type of run-ups before, and typically when the incline is sharp, the decline tends to be very sharp. I'm not saying that's going to happen today, but that's the risk, that the expectations just end up getting too high for the market size. And so if I take apart what's happened and this is now I want to tie this back to sort of overall positioning and what's happened to interest rates and inflation. Going back to my comment at the outset is what are we pricing in, a soft landing or a hard landing? So we know that the members of the Fed, they sit down in their meetings and they do what's called a dot plot. And what that is they essentially put little dots where they think interest rates are going to be 6 months, 9 months, 24 months out from where we are at the moment of that meeting. And so if we go back to the January 4th meeting, what I did here was I compiled them and allocated them in percentage to the total allocation of the Fed members. And you can see that on average, they expected at the beginning of the year that we would end 2024 with a Fed funds rate somewhere between 3.5 and 4, more likely 3.75, which would be 6 quarter point cuts from where we started. If we take it to where we are today, the most recent meeting, May 21st, they issued the dot plot, and those same humans sat down and said, you know what? It's very likely that rates are going to be probably where they are right now by the end of the year, thinking about 5%. And there are a significant number of humans sitting on that committee that think that the rates are actually going to be higher than they are right now. And yet, as this little squiggly line will show you, the S&P 500 is up 12% year to date. If I didn't tell you, if all you knew was in the last 5 months, would have been the switch in expectations for earnings for Fed funds rate, I wonder if you would answer that equation by saying that the S&P 500 would be up 12. So with that in mind, I ask you to think about your positioning and think what happens if inflation proves to be sticky? What if the Canadian market outperforms the US market? And if bond and equity risk premiums normalize? How are your client portfolios positioned? All right, so there's my 20,000 foot view with a specific emphasis thinking, I think it's time to start thinking again about Canada. And I'm going to start, of course, with the biggest sector in Canada. I'm going to talk about the Canadian banks. And I can lead, cut to the chase here. We're not excited about any of the banks here. And it's not that they're not great businesses. They're not that they're going to cut their dividend. It's just that when we look at their prospects from here, and they've had a beautiful run up, especially now, which we're trying to understand why that's happened. Maybe that's expectations for interest rate cuts, et cetera. That again don't jive with what the Fed funds, where Fed members are saying. And so when we look at the concerns really for the banks, it comes down to their customers, and that's the individuals. The debt service ratio, which is the cost of carrying your debt, principal and interest sitting in humans' hands in Canada, you can see that right now we're sitting at essentially an all-time high, 15% of disposable income being to carry the cost of carrying our debt. That's the peak that it was in 2007. And the projection going forward, and these aren't our projections, this is coming right out of the government. And let's say they're wrong by half and we're only up 6 to 16%. The point is it's higher than it's ever been. And I'm sure you've seen numerous charts that look something similar to this. We're all aware that there's essentially a brick wall cement wall that people are going to be running into when their mortgage rates are up for renewal, with increases anywhere between 20 and 60, 70% increases in their payments. Okay. And that's going to lead to pain. That means something has to give. You know, all the things that you typically would buy at Canadian Tire. I always come home, tell my wife, everything I bought at Canadian Tire, I'm going to use one day. Rob's going to call me asking me for something and I'm going to give it to him. But really, none of the things we buy there typically we actually need. Um, and so that's why the discretionary retailers, I think, are going to get hurt. And the banks, by default, get hurt because customers end up having, and you're already starting to see insolvencies rise, delinquencies rise, still not in dangerous territory, but the trend is heading in the wrong direction. It all ties to variable rate mortgages. We dig through the details. We go through which banks, what kind of variable rate mortgage products do they have? Because it's not just variable rate mortgage, it's what kind of product. And so the variable rate mortgage products that Scotiabank has and National, those move as the rate moves, whereas the other four banks, their payment doesn't move, and therefore you end up with a situation where the mortgages at BMO, CIBC, and TD are actually a meaningful proportion of them. We're talking 12 to 50 to over 15% at BMO are actually negatively amortizing. So this has already been an issue for OSFI. OSFI's mentioned that this is a problem. They've leaned on the banks to not do this, considered comments about capital ratios as a result of this. We think this means that their customers are going to run into problems, which means that PCL rates are too low. Our analyst has done an extensive dive looking at what happened in the financial crisis, looking at what happened since that time to see where PCL rates have been, and he thinks that they're underestimating, or consensus is underappreciating how high they need to go. We dig and have a real estate conference every year. We've been doing that for the last 11 years. This year will be our 12th annual. And we spend specific amount of time because it's just so important in Canada. It's 10% plus of our employment, 8-9% of our GDP. And so that means that what happens in real estate, in case you guys haven't figured this out, is going to impact our Canadian economy and therefore the bank customers. And so we look at number of months of inventory. We just finished having a sort of a mid-year checkup for real estate. And what you can see here, we look at months of inventory. This is the number of houses for sale divided by the number of units sold over the last 12 months divided by the number of sales in the last month. And so what you can see is that tells you the number of units that are available, that have turned or that are sitting in inventory. And you can see the bottom was in February 2022, which is amazing because that's the period, that's when house prices peaked. And so as the in months of inventory rises, that's when pressure on prices. Now we've been holding pretty steady here, nowhere near problem levels, but the trend has kind of been in the wrong direction. This shows months of inventory for the Toronto area, again off the bottoms, not in sort of dangerous territory, but there just seems to be quite a concern, especially on the condo market and especially with investors. We do spend specific attention looking at investor condos and the investor market because we think that's where the cracks are going to show first. And in Vancouver, similarly, I mean, we're up off the all-time lows here in January 2022, but the level of inventory nowhere near sort of panic levels. And as we look, I mean, starting tomorrow, good timing here on this call. Starting tomorrow, we'll see Q2 results come out, and we think we're concerned because deposit trends are going to be negative. People are putting more money into fixed income and that, or into sort of locked-in term deposit as opposed to sort of demand deposits. That squeezes banks' NIMs, credit losses. Again, I've spoken to why we think that's light. We expect that the banks are going to have a pretty good capital markets business and wealth management, but the problem is that's not a predictable part of the business. So if we have trends of problems of deposits growth and deposit NIMs as well as credit losses, we think that's going to weigh on earnings, and we expect that to play out into some potential weakness in the Canadian banks. On the diversified industrials and energy, we've got our, and I always put our analyst name down here. I'm just standing on the shoulders of my team here, as presenting our sort of overall views on things. When I look at, I wanted to touch on a name that we've been positive on for quite some time, and it's a long history even for myself, because I wrote about Bombardier way back in 2020, in 2001, Rob, before you were born. And at that time, I was commenting that they were cooking the books, that their prospects were a problem. This is even before 9/11. They threatened us with a lawsuit. We got into it with them, and then over time we've continued to cover them, and in various times we've been positive, but most of that time period we've been negative. And then we turned positive, especially after there was this big sell. They sold the regional jet business, they sold the commercial jet business, and they sold the rec products business, and basically they were just a business jet business. And we always said that was actually the core best aviation business that they had, probably the most profitable business outside of BRP. Anyway, and so what we wrote at the time in 2020, we felt really the market was more scared than it needed to be. The balance sheet was a big issue, and we said, you know what, this balance sheet will get rectified. They have a real business here with a huge backlog, and so on. People will start flying again. After COVID, that was a whole problem. We thought there could actually be even plus for business jets because people want to be more secluded. And so it was essentially, we looked at it and said, this is the mother of all terminal value bets, because the valuation of this business is all tied to sort of terminal value. And sorry, just before today, the stocks had a big run today, just on the U.S. I think Bank of America put a big buy on it. Thanks for that. But we've been calling this name to be positive for a long time, and our current estimate, we think we're starting to get a little bit rich, but if they do attain its targets that they've given, we think that this stock could have upside to $114 to $160. So even at the current $90 or wherever it is today, probably doesn't look that bad. In the longer term. On the energy space, we're more positive than negative. Look, there's conflicting trends here. I don't want to spend time trying to tell you our overall prediction for why what we feel about the oil price, but I can safe to say that we expect somewhere between $75 and $90 as a more likely price for the current year. And in that environment, two names that we really like. One is Suncor, and then an interesting news out today, something we've been talking about for years actually, is that Suncor should deal with its Petro-Canada stations, sell some of them, restructure some of them. Now they've changed management. We think that could be a nice catalyst for them, along with them dealing with debottlenecking and other issues. And the Cenovus, just this is a name that's been left for dead. They hated it. They cut the dividend, and those are the times when you got to buy the fear. And so that's when our analysts really got excited about it. So when we look at the big oil sands names, we look at sort of base case price evaluation here, and then we take a worst case, best case, 75 to 95 in terms of a range of outcomes for what we think the value of each of the names could be. And you can see that obviously the higher oil price shouldn't be any surprise to anybody. They all have upside. It's more a question of who has the least amount of downside. And Cenovus is looking really interesting here as a name that even in downside, it actually has pretty significant sort of stability in its price. On the golds and on the materials, I'm going to try to keep this very simple. Buy gold. I thought that would be really easy. You guys won't forget that. And so we'll keep it easy in terms of, look, I can go over time. There's lots of reasons why at times you should buy gold. And typically it's been tied to what interest rates do, and especially real interest rates. And one of the things that we've seen here, which is kind of an anomaly, you can see the gold price here in gold. The red is the 10-year treasury. The green is the real interest rate expectations for 3 months out. And typically when the green line falls, then the yellow line goes up. When the green line goes up, the yellow line tends to go down. We've had what is one of the sharpest increases in real rates in a long time. I'd even wager to bet that it's the sharpest ever. And what you see is that the gold price has continued to go up, which suggests that there's something else at play. So and we think that eventually rates will normalize and start to come down. We don't think that we're going to get back down to 1%. Our estimate thinking somewhere between 3 and 4 is more likely for a Fed funds rate to look forward to in sort of the medium term. And so in that environment, that obviously provides a catalyst to gold as well. But there seems to be other drivers for the price. Perhaps it's China buying, India buying. All central banks tend to have had under reserved on their gold, and so those are trends that we think as the geopolitics in the world continue to escalate. I mean, I'm sure all of you are aware there's going to be a party this November down south in the U.S. between two guys. They're going to get together, high five after they run an election race. And so I'm sure that won't cause any political unrest that would probably lead to more interest in things like gold. And so two names we like here, if you're more conservative, Wheaton looks like an interesting play. It's a streamer, so you benefit from the price going up and companies that they've contracted with in their ability to produce. Lundin is a little bit more risky, name that we like, as well as Angenico in terms of the two producers. On Nutrien, this is a name our analysts didn't like for a long time. Went positive on it not that long ago. Sees that there's a turnaround potential here. The underlying pricing of potash seems to have stabilized, increased slightly, as well as the other ammonia and so forth. And so that we think is something that could lead to a re-rating for Nutrien. You saw they had some decent results in last quarter. There could be some headwinds near term if the rails end up having a strike, and we think that's a good possibility just given the union strife we're seeing everywhere. I got on the TTC this morning and somebody handed me a paper about some TTC workers upset about about their wages. This is something that's going to continue. This is why inflation is hard to deal with. You have inflation in prices, and then people complain, and then wages increase, and then you have more inflation because the that second factor which lags, which are the people pushing inflation. Because if we increase wages, well, how do companies deal with that? They either fire people or they increase prices. So Nutrient's interesting here, and Nutrient doesn't care about what happens to unemployment, what happens to the macro environment generally. Farmers have put off putting potash into their land over the last year, especially last summer. So we think this summer is going to look better for them, and that should play very nicely to potash. I thought today I would, because we're talking about picks and pans, I would take a moment and tell you about really an outside view we've had for the last few months, and that's on copper. And copper's hit all-time highs, and now the momentum guys are in there and so forth. And this is, not unusual for us to be way early. We've been concerned about copper, and the key reason is, if you look at China, you just saw some GDP numbers come out from them and that show that they're weak. Okay, it represents 50% of copper's world consumption, and about 25 to 30% of that is driven by real estate. Now, we don't just spend time looking at Canadian real estate. We look at U.S. real estate. We look at China real estate. And so Chinese real estate, new completions down huge, new starts down huge. They're having trouble over there closing on their deals, just like we're having trouble closing on our deals. And so the prospects for new construction in China are way down. And so as a result of that, where is this new demand for copper coming from? And as a result, our guy has been cautious on copper. He thinks the run-up's overdone. EV, we've done a lot of work. We cover the auto guys. And there was a big dream that we'd be so much percentage EV. I challenged you people on the call. How many of you actually have an EV already? And if the people on this call don't have an EV, how is Joe Sixpack going to be able to afford an EV? And that's really the problem that it's coming down to. Buying cars is a financing game and pricing game. And so the secondary great thing is obviously climate control or climate concerns. Not that it's not important, but if you can't afford to buy groceries, you might not be thinking about spending more for an EV. So with that, we don't like Lundin mines, and we don't like Tech Cominco or Tech B. On the telco side, this is something interesting for us. We've done a lot of work on the telcos, especially paying attention to BCE. As late last year and in the fall, we commented that we were concerned about BCE's cash flow and its ability to sustain its dividend. So we went to a sell. And I just want to make the contrast here. Our analyst Desmond covers telcos and technology stocks, and I think Constellation shows a nice corollary to the telcos. Biggest problem, we all complain about paying too much for our mobile service, and I'm not here to challenge that that's not the case. We do pay more than the rest of the world, but without trying to support them one way or another, the key point is the companies themselves have been fighting tooth and nail over the last couple of years, as shown in this chart, offering lower price with more data, with faster data speed. And also in more recent times, they're offering US data roaming for free. And so as the companies battle with each other on price, well, what happens to margins? What happens to cash flow? And the problem with cash flows, and I use this as an example really to highlight the type of work that we do at Veritas. There's a textbook many have probably studied in the CFA textbook. It says, here's how you calculate free cash flow. Take working capital, deduct CapEx, gives you a number called free cash flow. If you believe it, you deserve it. Doesn't work that way in every company, in every life cycle, in every with all the peculiarities that exist in today's financing market, especially. And so we've actually done a whole course on understanding the free cash flow. We call it the secrets of free cash flow. It's available on, if you go to our website, veritasu.ca. We actually have run a whole online training program to learn how to calculate free cash flow and all the peculiarities. And so when we look at the free cash flow, you'd think it'd be relatively consistent among the telco players. It's not. So we have to make a number of adjustments to working capital, changes in contract assets, lease payments, etc., in order to normalize them. So that's what we did. We normalized BCE's numbers. And what this chart shows you is 6 years worth of free cash as reported by BCE, their own numbers, projecting through 2024 with their own numbers, have declined on a cumulative average growth rate of 5.2%. In the meantime, this line down here shows you the dividends that they've paid each year in cash, plus the projection for 2024. And you can see that that's going to grow. That has grown at the same 5.2%. You actually couldn't make this up if you tried to say, hey, even though our cash flows are declining by 5.2%, nobody's going to notice. We'll just increase our dividend by 5.2%. And you know what? Everything's going to work out just fine. Well, everything works out just fine until it doesn't. And so these are one of the things that I like to, one of my quotes that I like to always say is none of these issues matter until they matter. And then when they matter a lot. And that's what this kind of situation is when we're looking at a company like BCE. Is it going to cut its dividend? Hard to say. But are they going to increase their dividend? That'd be a real stretch. Are they going to be able to expand their fiber network to compete with Rogers, to compete with TELUS? That's going to be a stretch. Are they going to be able to defend their as people cut cable and cut home line service? Are they going to be able to defend their price? Probably not. And so these are the challenges, and that's why we calculate our own payout ratios, and we're still concerned about BCE. And so our top pick on the telco side would be Rogers. Has trades at a lower multiple, has a better free cash flow yield, better dividend yield. Okay, and In fact, we think that once it cleans up its balance sheet, generates cash from following the Shaw acquisition, pays down debt, we think it's going to start increasing its dividend, and people will re-rate the name. When you look at CSU, this is a growth by acquisition story. This is Constellation Software. Our current estimate is for it the valuation of 4,200. This just shows the annual spend that they've had on acquisitions, and it's amazing. On the surface, having been involved in research now over 25 years, and I can tell you many of the growth by acquisition stories, the street or the market's littered with their bodies. And this name has really stood the test of time because it makes acquisitions, so it basically deploys capital and generates great rates of return. And so that's what this chart shows. Capital, telcos also deploy significant amounts of capital, but they are able to generate significantly better returns on invested capital. So the dividend payout ratio, you're not buying Constellation Software for dividends, right? The telcos pay between 50 and 100% of their cash flow. The retention ratio, how much of that cash flow or of the cash flow do they retain? Well, in the case of CSU, 95%, whereas telcos, because they have to spend and you have BCE being negative, it's anywhere between 50% negative and 50% that they have left. So they don't have as much capital left to invest. And when they do invest, the telcos generate between 6 and 8% return on invested capital compared to 25% for the likes of Constellation Software. So not a name that we have liked for some time. I'm going to take a quick moment here, but we've done extensive amount of work on Brookfield and all its entities. And I think what's very unique about how we do work on Brookfield is we have two humans. They look at, and this is Dimitri, he was the same analyst that covered SNC, testified to the SEC in relation to the work he did on Valiant, was the first and only sell back in 2012 and 13, actually. So he's the one that's been concerned about and done the work on Brookfield. And really it comes down to, they've been doing a lot more sales. They've been great at buying assets and selling those assets at a profit, which works really well when interest rates are declining. When interest rates rise, it's a lot more difficult. And when they stay high, it's like being in a vice of pressure. And so what we're seeing is they're doing many more transactions with themselves, where BEP is selling assets to a new fund created by BAM. BIP is selling assets to a new fund created by BAM, okay, to the tune of like hundreds of millions of dollars. BN is selling real estate to its own insurance business. BN is selling other kinds of assets to this insurance business to the tunes of billions of dollars. Now, there's nothing wrong with that. It's just, it may be that when you sell to yourself, wouldn't it be better to sell it externally and therefore perhaps get third-party verification on the pricing? We're not sure. But anyway, this just makes us a little bit more concerned, especially when we look at the overall structure of the Brookfield conglomerate, and we see that all the public affiliates that you see down here, they're all owned between 26 and 100% by Brookfield Corp, and they end up paying management fees to Brookfield Asset Management, which is 75% owned by Brookfield Corp. So in other words, you're basically paying these management fees to yourself and then recording them as revenue, taking profits, etc. So again, this is another one of those situations where none of this matters until it matters, and then if it does, it could matter a lot. Now, if interest rates were to fall 200, 300 basis points in the next 6 to 12 months, maybe none of this matters. But if that doesn't happen, there could be some challenges. On the utility side, our guy has a little bit, I think, a lot of consensus here. He thinks it's going to outperform the TSX here only when risk-free rates fall, particularly the 5-year term, and debt risk premiums rise. So we haven't had that happen, right? Risk-free rates have risen and debt risk premiums have actually shrunk. Okay. So right now, like we just saw that, our analyst this morning in our morning meeting was talking on the REIT side. Shalab was talking about how Chartwell, I think, or one of the REITs, Choice, was able to raise debt at 150 basis points above corporates. I mean, it's a fantastic, this is the lowest they've ever been able to raise on a spread basis. So what that suggests was that there's really not much risk being priced into the debt space. And so when you look at when he thinks about the names that are going to outperform, he looks at those names that generate more adjusted funds from operations or cash flow per share, and those ones, and we want to stay away from those that are have poor debt or credit ratings. And so names that he really likes, if you look at you look at the names that have been able to generate more adjusted funds from operations growth in the likes of Keyera, Enbridge, Gibson, better than, Superior Plus and TC Energy. And so that's why he's been a little bit more cautious on these names. Because he looks at the balance sheet and also compares and looks at the cash flow. So when I summarize that up, on the pipelines, his top pick would be Enbridge. On the regulated utilities, ATCO, AltaGas, Fortis, and Hydro One, and the power producers, Capital Power. And interestingly, we have a sell on Emera, and Emera, because it has a bad balance sheet. They've already had some questions from the bond rating agencies. We think it could be a situation that ends up being like BCE, where the company just can't grow its dividend. A couple other names I'll leave you with. One is Canada Goose. Been banging the table on this for quite some time as the company's had its problems. It just published a great print on the quarter and gave decent guidance for the year. You have to ask yourself, is Canada Goose a brand? And if it is a brand, it's going to work. Because you're buying it today, even with the recent run up, at its historically low multiple valuation. And I know we've seen this happen before. Just pull up a chart of the Crocs, and you'll see that sometimes these big names come out of favor. Lastly, I'll leave you with our REIT space. Our analyst does an interesting job looking at REITs, and it's all about how you do your work. So we're looking at the fundamentals. We look at earnings growth, and earnings growth not just coming from earnings, and obviously net operating earnings per unit, but he also looks at the funds from operations per unit. So cash flow metrics. Then when we look at payout ratios, we don't look at earnings payout ratios. We look at cash flow payout ratios, much more important to understanding sustainability. We look at credit metrics, net debt to EBITDA. We look at interest coverage, and of course, macro trends. What's there, just because there is such a thing, there are office REITs, maybe we don't want to have them in today's current environment, just given the stress that they're under. So our top picks here would be Killam on the residential side, RioCan on the retail side, and Granite on the industrial side. So I'll leave you with a thought, two of them. And then one is, what's priced into the names that you own, a soft landing or a hard landing, and how's that going to play out if because I think the market generally is really baking in a soft landing. And if it's anything harder than soft, that'll have ripple effects. And I think, when you look at where we are with inflation, what if it proves to be more sticky? What if the Canadian market outperforms the US market? And what if bond and equity risk premiums normalize? Basically, what's that going to mean to your client portfolios? And is there a way perhaps we can help with that? So I'll leave it there. If anybody has any questions, we're happy to take them. And Rob, I think I don't know if you can see this as well, but we did get a question. Is it possible to have the performance and cost split between the core strategy and the option overlay?
Yeah, so we don't have that split yet, but we're looking at providing it. There's a fair bit of transactions to do so, but because of the activity within the options side, as opposed to a set it and forget it type strategy. But we can give you a better answer at one point in the coming weeks. If anyone else has any other questions for Anthony or myself, please feel free to type them into the chat box. Maybe while we wait a minute or so, Anthony, I'll start off with one. You mentioned off at the start of your chat just about having identified some of the big blowups that's happened in the Canadian marketplace over the last 20 years, whether it's been the Nortel, the Valiants, the Blackberries, Yellow Pages, things like that. I guess in some instances, they can be somewhat cyclical towards the aggressiveness towards expectations from investors and how people get aggressive with accounting. Is that a fair statement? And, if that's a fair statement, are we getting to a stage like that right now, or is it kind of status quo out there?
It's funny you say that. I recently spoke at two conferences. One, the audit regulators, global audit regulators, had a conference, and I spoke about fraud. It was specifically about fraud, and I gave investors' view of what's happening with fraud. And then U of T had a conference on fraud in accounting and audit. And I spoke similarly to that one. And I remember, so the short answer is yes. I think we are actually entering a point in the cycle where it really tastes like and smells like what it felt like in 2000, and where people weren't paying attention to fundamentals, and multiples continued to expand, and we saw that was, when we started the business, we were able to identify many companies that weren't generating cash, or that who were playing with their accounting. And we'd just done a study. We looked at the big seven, and we looked at how names like Microsoft and Amazon and and Google or Alphabet have actually changed their depreciation rates twice, both first in the 2021 fiscal years and then also in 2023 fiscal years, to extend the amortization period of their networks and servers from 2 years to 4 years, then 4 years to 6 years, such that much of the earnings growth, I'm talking the net earnings growth, came from just changing depreciation rates. Now, again, nobody cares. It doesn't matter. These are great companies. This is not to say to sell them. They're great companies. They generate cash. They're not going out of business. Actually, they don't even trade at ridiculous multiples, a number of them. But the question is, we are still paying for growth. And if that growth rate slows, I can bet all my money that the multiple will contract. And so we're at a point where really what's holding up this market is that the earnings come in, because if there's any slip ups, there's going to be drawdowns, and I don't think market positioning is there to reflect that. I mean, it's you've seen these metrics before. Look, the concentration of the S&P 500 among the Magnificent Seven is the tightest it's been in history. Now, again, doesn't matter. So what? That's just a fact. It's not analysis, but typically when all that risk goes in those names and everyone's buying passive money, right? So passive money just buys those same 7 names, because when you put your money in an ETF of S&P 500, where do you think most of the money goes? In those 7 names. And it's muddy weighted, and that makes the index go higher. And then they tell 2 friends and they buy the index, and those same 7 names go up and the index goes up. And so this is the risk that we're under, I think, that we'll see what happens.
Good answer.
Well, we didn't even practice that.
No, that was just the question I just came up with, Anthony, but it's
thanks.
No further questions in the queue. So I just want to say thanks for everyone that joined. If you have any questions, please feel free to reach out to us or your regional sales rep. And Anthony, always a pleasure. And
likewise, Rob.
All right.
Take care.
Bye.
All the best, everyone.